Hello friends, welcome back. And today we would be continuing with what we left in our previous video. We were talking about how RBI controls the money and credit into the economy. And in our previous video, we talked about this, that money supply has to be coordinated and controlled, because if money supply is out of control, it creates the problems of inflation or deflation. And the tools which RBI uses are quantitative and qualitative in nature, and we have already done the quantitative aspect, all the 6 7 tools of RBI, wherein the logic remains same everywhere. I tried giving you this logic in previous video also, that in case of inflation, RBI increases every sort of rate or every sort of reserve and decreases every sort of rate and reserve to curb on inflation and deflation. I tried giving you this example of case 1 and 2 here, which simply say that there is simply a contrast whether RBI releases the money in a cheap format or expensive format, because if the money goes cheap to commercial banks, that would remain cheaper, right, for public. But if for example, if 3% is the rate charged by RBI, it will be 6 to the public. But if RBI increases from 3 to 5, it will also be increased from 6 to 8, and hence the loan becomes expensive for the public in general. And hence, whenever the loans are expensive, people demand less and the supply is controlled. So in our previous video, we tried going in this detail of the mechanism of all the quantitative tools, and these are the quantitative tools: bank rate, repo rate, reverse repo rate, CRR, SLR, and open market operations. Very often this open market operation, I don't know why, is the favorite of all the paper setters, and this question is most often asked in the papers. At times you must be ready with the difference between CRR and SLR also. Sometimes their definitions are also asked. Right. So let's begin with today's work, and we are to talk about the qualitative tools today. Before moving any further, you must note that quantitative are general, but qualitative are specific tools. Quantitative show and talk about the quantum of money released in the economy, but qualitative tool basically focus on the direction and the sectors to which the money is and the credit is going. So in this qualitative tool, the very first I'm taking is margin requirement. And when I say margin requirement, margin means it would definitely be a difference of something. Let me give you an example. For example, a loan of say rupees 50 lakhs, 30 lakhs is required, right? And for that, the commercial bank says, let us have the collateral, or you may say the security, worth rupees 50 lakhs. It means what is the margin kept by bank with them in case there is any default, so that collateral will be uh, sold and disposed of, and the loan would be recovered from the market. So margin is the value of this collateral offered and the loan given by the commercial bank. So this difference, that is rupees 20 lakhs here, is the collateral, is the margin requirement, right? So now the story revolves around this, whether RBI increases or decreases the margin requirement in case of inflation. I told you, you simply go by the term. Inflation means all these things are to be increased, and deflation means all these things are to be decreased. So what happens here in case of inflation? What is the inflation problem? Problem is the money is more in the economy. Money supply is high. So what government wants, what RBI wants? RBI wants to curb on the money supply. So it wants to reduce the demand of interest from the people. And when would it be reduced? When the margins are higher. So in case of inflation, the margin is increased by the RBI, and in case of deflation, the margin is decreased by the RBI. In case of deflation, the margin would be required lesser. It means, for example, for a loan worth rupees 30 lakhs, it's not 50, but the 40 lakhs of collateral is required. So people are required to give or banks keep margin of 10 lakhs, and people are required to give the lesser value of collateral with the commercial banks. In this case, it would be little easy for them, and hence the demand for loan would be increased. Right. Moving ahead, the next is moral suasion. And when I say moral suasion, it is actually a combination of persuasion as well as pressure. What do we mean by this? RBI tries to persuade all the commercial banking units in the direction of the economic requirement, like whether to release the loans easily, lavishly, abundantly, or to curb the same. So, accordingly, they simply keep on giving the directions by meetings, circulars, some other emails, and all. So, this is all the persuasion of RBI, right? At times, most of the banking units do by the rules and the directives given by the RBI, but if at all there is some deviation, RBI is the apex authority, so it can pressurize them by imposing certain sort of penalties or delisting them from the banking work, right? So moral suasion means that persuasion which RBI does for just aligning all the banking units for the required situation. And then the last is selective credit control. When I say selective credit control, it means there is a direction given by the RBI that which sector should be boosted or which sector should not be given the loans, right? So there can be the positive lists made in this regard, and there can be the negative lists also made in this regard. What do you mean by the term positive list? Positive list means when which sectors should be given the preference, and negative list means which sectors should not be given the preference, in fact should be curbed. So for example, if I say government wants to focus more on exports, or it wants to give a good threshold to the startups, right? Or you may say agriculture is the priority sector. So any such sector, if it is given by the government, so these sectors should be given more and more money and loans, right? Negative means if a particular sector can be listed here, so that there the amount of money going in terms of loan can be curbed. So this way RBI tries to tell through it and get the things executed through the commercial banks where to give the money, where not to give the money, how much to give the money, right? And in this way, it controls the supply of money in the economy. With this, we come to the closure of this chapter. We are done with money and banking in totality. All the doubts are welcome. Have a good day. Bye. God bless.